trajectory of the business cycle is for there to be a recession every 7 years. That means that every 7 years, most economies across the world face a time in which there is immense risk to everyone who is vulnerable in that society. A time where mismanagement and the incapacity to reflate that economy and get investment going will keep people in poverty and destitution for years. Our extension from closing government is to nationalize banks, fix the sort of problems associated with the zero lower bound in some of the most biggest monetary problems that are facing global economies in the world. Before that, I have 3 pieces to rebuttal. First of all, on inefficiencies, opening opposition will concern we might shut out investment towards new and innovative sort of ideas and hurt economies in that way. Note that banks do not tend to lend to these sorts of new and innovative things. Venture capital is the ones that do that. Banks tend to lend to things that have solid asset bases and have collateral to secure those sorts of loans. So it is simply untrue to suggest that we are cutting out the engine room of economies in that way. Second of all, on confidence, the strongest claim from opening opposition was that governments have better accountability. We would make an observation, first of all, that governments want their economy to work effectively, for the simple reason that you do not lose one election if you are the government that caused the economy to go down the shitter because you used a nationalised bank facility. You tend to lose 3 or 4 and entrench yourself out of the political structure for a long period of time. But let's be very clear, right? Opening opposition played a bit of a trick. In countries that have very good regulatory structures like the UK and US, it is probably true of 2 things. First of all, that we can force openness about what these banks do and hold them accountable. And second of all, the people who are going to be very trusted economists who are very confident in what they're doing and don't make silly decisions. In the developing world, where there are sorts of political capture or incentives that might mean that governments are ineffective in the way the people they put in there or what they choose to do, we think the comparative is simply those same governments controlling the regulation they wanted to run all of those banks themselves and additionally inflicting other things through whatever mechanism is most easily available to them. But let's look at some of the associated harms of their policy, right? Because a bailout takes time to draft. It wasn't up to them to say, we can bail out or rescue a bank after the fact, because that makes the shock worse, because you have to wait for the bailout to be drafted, wait for it to get through. The same sort of complicated political structure, at which time it might get worse. And additionally, we think there's awful political incentives that are in play for them as well, right? So for instance, it was difficult for the US government to get the political support to bail out the Lehman Brothers, right? Because it was so toxic and no one wanted to be associated with it. No one thought that their money should be going to save that institution. The consequence of that is that a bank that should have been bailed out probably wasn't, and people had to suffer as a consequence. And the market understands this instability and faces it. So if political constraints were their concern, it was not clear they were helping it. Last of all, on the developing world, right? Like third world banks are pulling on a lot. Additionally, to this whole confidence thing, let's be very clear, right? Some banks are not very large, so it's unclear we're nationalising every bank in the world, right? Only just those who are systemic. That was in the motion. On the developing world, we don't think the third world banks are the main capital source for large places. Things like private capital and microfinance will still exist. And we point out that many banks simply would be making the sorts of loans they think are important, right? Banks aren't going to loan out to very risky things in the developing world, and that is what we're shutting off, right? These things are risky, banks tend to lend to things that are more useful. What is our extension? It is on monetary policy. Now I'm going to spend a bit of time explaining why this is exceptionally important. So the Eurozone, the UK, the US, and Japan are some of the biggest economies in the world. All of those places either sit at, or in some instances below, the zero lower bound. What do I mean by that? It means that interest rates effectively sit at 0%, which means there is no capacity for government to do what they would traditionally do if there is a slowdown of growth. There's no capacity to use their normal mechanisms, right? So here is what happens as a result. It means that when a recession hits, they don't have the tools at their disposal to be able to address those sorts of things. They can't lower interest rates because there is nowhere else to go below 0. This does 2 things. In the first instance, it makes recessions go on for longer. In the second, it makes them worse. And let's be very clear. Think about the countries I just mentioned. These are places like the US, the Eurozone, Japan. Even if you care about the developing world, those economies doing well, those Western ones, are the most crucial thing for those economies doing well because they take down the global economy as a whole. That's why the 2008 recession didn't just hurt people in the Western world, it radiated out to the entire rest of the world, which is why proving that this is improved on our side of the house is far and away the most crucial monetary policy question that is in the debate and indeed facing global economies well into the future. Why does this fix this? First of all, because we think nationalised banks are a mechanism for governments to lend directly. If you own the banks, you own all the important and large ones, you can directly set the conditions by which loans are given. So even under the status quo, where governments may be able to incentivise banks to loan more, they cannot guarantee the banks will want to loan those things more. Indeed, banks' incentive is to fix their balance sheet first of all. They want to make sure that their bank, their own institution, is safe. Not give out the lending that's necessary to restart that sort of investment and economy. But second of all, even where for instance, we can't give out loans, right? What we can do is adjust the interest rates on loans that are already held. No bank would be willing to write down the interest rate on a loan they're given to another company, right? For the same reason, because their loans will be affected and their company is being poorer. A government could do that because recognizing that, for instance, might want to target certain aspects of the economy that need that growth to restart it, so they can start reflating the economy and getting things better. Second of all, there's an expectation problem, because one of the biggest difficulties is if the market knows that a government has no systemic tool at its disposal to fix the sort of problems that it is facing, it has no traditional mechanisms to fix this problem, it doesn't have the confidence that growth will begin to happen again, which has a multiplier effect, right? Because if people think the problem will be systemic and embedded long into the future, they don't do the sort of investment themselves that would help to fix the problem, so it gets substantially worse. What this does is give a clear mechanism for every important government in the world to be able to address these sorts of difficulties, and I'll take you in a second opening opposition, which means that we get over that expectational deficit. Sure.
Really simple question. Why are the benefits that you just talked about not existing in a world where there's a public option for financial institutions and a private option that holds them accountable in the efficiency that you want so much?
I don't understand. But okay, because you can't force a bank, for instance. Okay, if your policy is like, we're going to force every bank to do everything you would ever want, then all you're suggesting is our policy without the flexibility and like the additional time lapse problem where like a bailout needs to occur but you can't get through. But additionally, let's go on to the political strength, which is also very important and suppose an additional response to them. It is often very difficult for governments to get these sorts of bailouts through, or to get the specific kind of bailout they want to get through past, because of the simple fact that they know that it's politically difficult to justify certain things. I've already given the example of the Lehman Brothers. Here's the difficulty, right? Opening opposition's apparent best conception was they would make sure that governments did the right thing in the right circumstances. That is entirely contingent on the government of the time having the capacity to do it, as they've explained themselves. The problem is, if you already own the fact there are strong norms of government using these sorts of nationalized banks in the national interest, and it is very directly and easily accessible to you to pursue those sorts of policies, that is more likely to happen, as opposed to the time-lagged and destructive situation on their side of the house, when any political party can force an inefficient solution to be given to that problem. We are the team in this debate that protected the world from some of the worst recessions in the world. Think 2008. Compare the recession in 2001 years to the recession in 2008. Think about how many lives were affected, how many people had to suffer a result, and live substantially worse lives. The difference between those two recessions is why you should vote for closing government.